Welcome to the award-winning Consumer Finance Monitor podcast, where we explore important new developments in the world of consumer financial services and what they mean for your business, your customers, and the industry. This is a weekly show brought to you by the Consumer Financial Services Group at the Ballard Spahr Law Firm. And I'm your host, Alan Kaplinski, the former practice group leader for 25 years, and now senior counsel of the Consumer Financial Services Group at Ballard Spahr. And I'm very pleased to be moderating today's program. For those of you who want even more information, either about the topic that we're going to be talking about today or anything else in the world of consumer financial services, please don't forget about our blog, consumerfinancemonitor.com. We've hosted our blog since 2011 when the CFPB became operational. There's a lot of relevant industry content there. We also regularly host webinars on subjects of interest to those in the industry. So to subscribe to our blog or to get on the list for our webinars, please visit us at ballardspahr.com. And if you like our podcast, please let us know about it. You can leave us a review on Apple Podcasts, YouTube, Spotify, or wherever you access your podcasts. And also, please let us know if you have ideas for any other topic that we should consider covering on a future podcast show or speakers that we should consider as guests on our show. Okay, turning to our program today, and I'm very, very excited about the program, not only because of our guest, who I will introduce to you in just a couple of minutes, but also the fact that I think you will agree with me after I'm done that the FTC is still very much open for business. And so while I would say that the CFPB has been largely emasculated in terms of its supervisory and enforcement functions and its very ambitious regulatory agenda, which is actually quite deregulatory in nature, the FTC continues to play a pivotal role in shaping consumer protection policy and enforcement across a broad range of non-bank industries. Today's webinar features Malini Mithal, Associate Director of the FTC's Division of Financial Practices. Malini will be providing insights into recent non-antitrust initiatives, in other words, consumer protection, and actions that have been taken by the FTC under the current administration. In response to a series of questions that I will pose to Malini, she's going to discuss recent and pending enforcement actions and settlements covering the following entities or issues: Fintechs, lending and payment companies, cryptocurrency platforms, bill payment providers, subscription practices, negative option users, auto finance companies, debt collection, credit relief, debt repair companies. We have divided this particular webinar into two segments. After I finish questioning Malini, then Malini will be logging off. She has another engagement that she has to attend to. And then I will pick up with my colleague, John Culhane, who I will introduce to you in a moment. So let me introduce Malini a little bit more. Well, now Malini is the Associate Director of the FTC's Division of Financial Practices. She's had a number of other positions at the FTC over the years. Under her current position, she supervises investigations, enforcement, and policy work, challenging unlawful conduct in the financial services arena. This work involves fintech issues, cash advance products, crypto platforms, auto finance, debt collection, small business financing, something which people often forget. This is not their jurisdiction. The FTC is quite a bit different than at the CFPB. Education, financing, and more. She received her law degree from Columbia Law School and her undergraduate degree from Georgetown. She's been a frequent guest on our webinars and podcast shows over the years. And when I co-chaired the Practicing Law Institute's annual Institute on Consumer Financial Services Law, something I did for 25 years, I would always invite Malini to be the FTC's representative on that program. She is a font of knowledge. So with that introduction, I want to extend a very warm welcome to Malini.
Thanks so much, Alan. I'm looking forward to chatting with everyone today.
And now let me turn to my colleague, John Culhane. John is a senior regulatory partner in the Consumer Financial Services Group, and as I'm sure you all know, a regular panelist on our webinars and our podcast show. His practice includes counseling on federal and state unfair, deceptive, and abusive practice laws, as well as assisting in the defense of related government enforcement actions and private litigation. So a welcome to you as well, John.
Thanks, Alan.
So at this point, I am going to turn the program over to Malini. Let me just advance one slide ahead. There we go. This will give you an idea of the questions that I'm going to be posing to Malini. So Malini, I know this very first question is a very basic question, and for a number of people on our webinar, I'm sure they know the answer, but we have a very large turnout this today, and I'm not sure everybody understands the FTC and its mission and jurisdiction. So if you could describe that to everybody, that'd be great.
Thanks, Alan. That sounds great. So before I begin, I wanted to just remind everyone that the remarks I make today are my own and not those of the Commission or any individual commissioner. So today I'm going to talk about the work the FTC has done. I'm not going to make any predictions about the future. I don't want to get ahead of my commissioners. So in terms of the FTC's mission, we are here to protect consumers and promote competition. That means that our work aims to protect not only consumers, but law-abiding companies as well. And we do that by making sure that companies that are engaged in unfair or deceptive acts or practices don't get people's business. So one example here is our auto finance work. We've heard from dealers that it's difficult to compete when their competitors are advertising very low prices that aren't actually available to consumers. But they do that to lure consumers to their dealerships and away from the dealerships that are advertising prices accurately. So they've asked us to do more in the auto space because when there are UDAPs, that means consumers as well as honest businesses lose out. So now on our jurisdiction, I want to very briefly make 3 points. First, we have broad jurisdiction over non-bank financial service providers. That means we brought actions against lenders and payment platforms like SoFi, Lending Club, Venmo, and more for making deceptive claims about fees and savings. We brought actions against debt collectors, including against one that parked debt on credit reports without first communicating to the alleged debtor. We brought cases against auto dealers that use bait and switch pricing tactics, and those are just some examples. Now, I want to briefly expand on what I mean by broad jurisdiction. So our jurisdiction is over persons, partnerships, and corporations. It doesn't depend on the type of product being offered. So let's say a company is offering a new type of financing product, and it structures the product in a way where there's no finance charge, but instead it charges a membership fee. Even if that company says that TILA doesn't apply, the FTC Act does. Now, the second point I want to make about our broad jurisdiction is that we have jurisdiction outside of financial markets as well. So we brought cases against general retailers like Amazon, Apple, and Google for charging people without their consent. We've had cases against lead generators and data brokers and general retailers, whether they are providing a financial service or not, for not safeguarding consumers' information. This is important because regardless of what industry you're in, there are lessons you can draw from our cases that apply across markets. For example, you can't charge without consent, and you have to safeguard people's information. A third point I want to make about our jurisdiction very briefly is that, as Alan alluded to earlier, we're not limited to protecting individual consumers. We can protect small businesses as well. And I will talk more about our work in that area today, but I'll turn it back to you for now, Alan.
Yeah. Thank you, Malini. So, Malini, let's talk about the FTC's primary tool, which is enforcement. What statutes does the FTC enforce? What enforcement powers do you actually have, and how do you use them?
Yes, absolutely. So we enforce a number of federal statutes. I'll start with the FTC Act, which prohibits UDAPs, or unfair or deceptive acts or practices. We have used our authority under this statute to bring cases against a lender saying there are no hidden fees, but then charging a large hidden upfront fee, against a for-profit school for saying you're likely to get a job, but not having the support to back that up, against supposedly neutral third-party review sites that rank lenders' products not based on objective criteria, but instead based on how much the lender pays them, and also against pay-to-payment platforms for telling you can transfer funds to your bank account overnight, but then later reversing the transaction. Examples of how we've used our unfairness authority include cases we brought against companies like AT&T and T-Mobile for hiding charges in your bill for additional products and services that you didn't order, aside from charges for your phone service, and cases against gaming app platforms like Apple, Amazon, and Google that we've said charge for kids' in-game purchases without account holder consent. Now, in addition to the FTC Act, we also enforce a number of financial statutes like the FTC Act and CLA, the Consumer Leasing Act, and also statutes that apply broadly regardless of what industry you're engaged in, like ROSCA, which is the Restore Online Shoppers Confidence Act, and it applies to subscriptions. I know we're going to talk more about that later, Alan.
Yeah. So the FTC continues to have a lot of activity involving fintechs and promises of quicker access to cash. Can you talk about those cases?
Yeah, so Alan, we see many companies that are supposedly leveraging technology to innovate to consumers' benefit. They distinguish themselves from traditional competitors with promise of quick access to money and faster loans. But then we say that they fall far short of those promises. So one example where we've said that is in cases involving cash advance products. I'm going to talk about our two most recent cases here. One is against Dave, and the second action is against Clio. So in our Dave action, we said that Dave promises consumers that they're going to receive up to $500 instantly in cash advances. But we say that in the first 14 months after Dave began advertising these advances, it offered the $500 advance only 0.002% of the time at a rate of less than 1 in 45,000. We said that when Dave did offer an advance, its most common offer was $25, and that more than 3/4 of the time, Dave didn't offer new users an advance at all. We also say that Dave charged a recurring membership fee and made it hard to cancel. We said that when consumers wanted to take an advance, they download the Dave app and they press a green button to connect to their bank account to receive the advance. But on that same screen, there's a small light-colored bit of text saying that Dave automatically charges $1 a month on a recurring basis. Consumers complained they were unaware of that fee. Then, for consumers who try to cancel, we allege that cancellation is difficult. So in addition to misreps regarding cash advance amounts and subscription issues, there's an aspect to this case that's new and different from our past cash advance cases that I want to focus on for a moment. We said that Dave also charges a surprise additional 15% of the amount in advances, and it calls this a tip. And that tip goes to increase Dave's revenue. It doesn't go to an individual, for example. The complaint lays out Dave's interface. So there's a screen that says your advance is on the way, and you have the option to tip to keep Dave in business. But there are different percentages listed underneath and a button that says leave a custom tip. If the consumer doesn't press any of those buttons and just hits the big button at the bottom of the screen that says thank you, she's automatically charged 15%, even though she hasn't pressed one of the percent buttons or the leave a custom tip button. And we say that that conduct violates the FTC Act and ROSCA. Now, our newest cash advance action is against the company called Clio. We brought this in March. We said that Clio deceived consumers about the amount they could get and promised instant or same-day advances of up to a certain amount. But in fact, we say consumers did not get the amount promised and that it could take days to get the supposedly same-day advances unless consumers paid extra. And even then, sometimes the money didn't arrive till the next day. We said that Clio has charged for a recurring subscription as well, like Dave did, and made it hard to cancel. For example, if consumers had an outstanding balance, they couldn't cancel until that balance was repaid. So in addition to having to pay that back, they were continuing to incur a monthly fee. We settled that action for $17 million.
Let's talk about a few related areas to what you just spoke about, namely fintech, lending, and payment cases. They often overlap. So do you have any other updates in this particular area in addition to the cash advance cases that you talked about?
Sure, Alan. Actually, a case that I think is good to highlight here is our case against Doxo and its two co-founders. So Doxo is a third-party bill payment company, but we say it impersonated first-party billers. So more specifically, we say that Doxo purchases search engine ads that appear when consumers search online for information about companies they owe bills to. The ads include headlines that include the company's name, but not Doxo's. We also say that Doxo's landing pages prominently feature the biller's company name and sometimes even their logo, even though Doxo has no formal relationship with the vast majority of billers. According to our complaint, once consumers are on Doxo's website, they enter their total amount, but then at the final step, Doxo adds an extra fee. The complaint also outlines Doxo's deceptive process to sign consumers up for a recurring subscription plan. So for a period of time, for example, the company would automatically check a box to sign consumers up for a subscription when they clicked on a general terms of service document. Our complaint also notes that even though Doxo immediately charges consumers for payments, in many cases, the company then prints a paper check that is mailed to the biller, and it arrives days or sometimes weeks after the customer believes their bill is paid. As a result, many consumers have had utilities shut off, they've had car and health insurance lapse, and they've been charged fees and fines even though they paid their bills on time. The complaint states that Doxo's internal surveys show consumers don't know that they're in a subscription plan. Hundreds of billers complained about the impersonation that is alleged in our complaint. Tens of thousands of consumers complained about these issues, and consumer complaints were so numerous that in 2021, employees of a major search engine declared Doxo's ads were super misleading, and I quote, super misleading. The complaint also points to multiple instances in which the company's top execs were personally made aware of the complaints against Doxo. So I think this case provides a good lesson that you're going to hear throughout a lot of FTC cases, which is pay attention to consumer complaints. Pay attention to what others in the industry are saying. If a lot of people are complaining about your practice, there's probably an issue and the FTC may come knocking on your door.
Okay, so Malini, you mentioned ROSCA. Well, let's talk a little bit more about ROSCA and subscriptions. You mentioned it in a few cases, and the FTC has been doing a lot of work here, including this year alone, with new cases brought against Uber and LA Fitness and a settlement against Match.
Sure, Alan. So the Restore Online Shoppers Confidence Act, or ROSCA, requires companies that sell subscription plans over the internet to disclose material terms before sign up. It also requires gaining express informed consent before charging, and that companies provide a simple mechanism to cancel recurring charges. We've brought ROSCA cases in a number of contexts, so I'm going to start by describing the cases you talked about. I'm going to go in depth on Uber, but then I'll do a briefer kind of summary of the other cases. So Uber was just filed a few months ago, and according to our complaint, Uber charges consumers for $10 a month or $96 a year for a subscription plan without consumers knowing about it. And even for consumers who have figured out they were enrolled, we say that Uber made it difficult for them to cancel or didn't let them cancel at all. So by way of background, for people who want to use Uber to book a ride, for example, you download the Uber app, you connect it to a payment method, and Uber charges that payment method for whatever rides you book. Our complaint states that consumers have reported that all of a sudden, they notice that Uber has been using that same payment method to charge them $10 a month or $96 a year for a subscription they never signed up for. And that's if they notice the charges at all. The complaint gives examples of how Uber signs you up through push notifications and pop-up ads and while you're booking rides. The FTC's complaint that the consumers in these examples never click a button labeled Join Uber One, they do not need to affirmatively enter any billing information, and Uber already has it stored if the consumer has ever taken a ride with Uber. So for example, consumers have said, I looked at my credit card bill and I just realized that Uber Eats has been charging me $9.99 a month for an Uber account for the past 8 months. I've never signed up for this service. Now, for consumers who find out they've been enrolled and try to cancel, we say that Uber has made it very difficult. We say consumers have to take at least 12 different actions and navigate a maze of at least 7 screens if they guess the right paths to use. We also say that if it's within 48 hours of the billing date, it's even harder. Consumers there have had to take as many as 32 actions and navigate as many as 23 screens if they guess the right paths to use. And that's if they only go through a loop we say that the app sends you on one time. Even after that, they have to contact customer service. And when they're able to reach customer service, sometimes it takes so long to respond that they're charged again without their consent. And this is all despite Uber promoting canceling anytime as one of the benefits of its subscription plan. Now, I mentioned a loop earlier. During that loop, consumers also encounter a screen that says they can save $25 a month if they keep their subscription. The complaint alleges that that savings claim is false, that many consumers actually don't save $25 a month. The complaint also states that cancellation is so challenging that it has spawned online tutorials attempting to explain how to cancel, which have been viewed tens of thousands of times and include comments from fed-up users. Okay, so I'm going to make just a few more points about LA Fitness and Match.com. So our LA Fitness action that we announced last month is, of course, against the nationwide gym chain. We say they charge hundreds of millions of dollars in unwanted recurring fees. We say that it has required consumers to use one of 2 cancellation processes. One directs consumers to submit a difficult-to-access form online and then to submit it in person at the gym. We say that consumers have to go to the gym and find a specific manager at the location who's authorized to process the forms. If the person isn't there, they have to come back another time. Another way to cancel is by mail, but there you have to use certified mail or registered mail, which requires a trip to the post office and additional costs. And we say that consumers who still take all these steps continue to be billed. Third, in Match.com, we said that there was also a confusing online cancellation process, and internally it was described as convoluted and confusing. As one example, we said consumers had to click through 2 pages of survey questions as part of the process. And responses to one question often required follow-up questions. So for example, clicking I had too much going on and did not have time to date results in the follow-up question, when do you feel you might be ready to date again, with 3 possible answers. We just settled that action for $14 million. Now, these cases involve mostly online and in-person cancellation difficulties. For an example where the only way to cancel was over the phone and the difficulties there, Vonage is a good case to look at. That case we settled for $100 million, and more details are available at our website, ftc.gov. These cases are just some examples of how subscription charges have continued to be an area of focus for the FTC. And I'll stop there, Alan.
Yeah, Thank you, Malini. So let's turn to another area that I had mentioned during my introductory remarks. A lot of people have a misimpression that the FTC only deals with consumer problems, consumer complaints, but that's a myth. So let's talk about this other area, namely small business financing. Can you tell our audience about your work there?
Yes, absolutely. So the FTC Act has no exclusion that makes it apply to only individual consumers, and we've been bringing actions protecting small businesses for decades. A recent one that I want to highlight is our case against Seek Capital. We said that Seek and its CEO advertised loans for small businesses, but signed up thousands of business consumers for credit cards instead. So basically, consumers told Seek that they were looking for money to buy a building or a truck or to pay an employee, common small business costs that require cash on hand. We said that consumers were then surprised to get credit cards in the mail and an invoice from Seek listing credit cards. We said that Seek charged consumers 10% of the total credit limit as a consulting fee, and that amounted to thousands of dollars per consumer. 2 banks sent Seek cease and desist letters. We said that Bank of America called it a sophisticated fraud and put systems in place to identify and deny applications coming from Seek, and fired some of its own employees who had accepted Seek applications. We said that the First National Bank of Omaha sent a cease and desist letter to Seek, calling the company's business a credit card stacking scheme. The bank forwarded that letter to state and federal regulators and copied Seek and its CEO, and still we said the company did not change its practices. We said that Seek's practices violate the FTC Act, the Telemarketing Sales Rule, and the Consumer Review Fairness Act, which prohibits companies from using contract clauses that suppress negative reviews. We said that Seek did that. So the court actually entered into a preliminary injunction in the FTC's favor, saying that we were likely to succeed in the merits of our claims. Now, some of the arguments made that the defendants rejected are ones where they said, we have disclosures in our paperwork about credit cards. The court said that the fact that some credit cards have this feature does not make defendants' indiscriminate use of the term credit cards with lines of credit non-deceptive. We also allege that Seek unfairly charged fees, for example, by inflating fees by securing more credit than consumers wanted. So, for example, one consumer needed access to $40,000 in cash to purchase a trailer for his trucking company. The defendants ultimately secured $60,000 with 10% paid to defendants as a fee. That was what was listed on their invoice. But the court said we were unlikely to succeed on the merits of our unfairness count here. And that's it for small business financing for now.
Yeah, okay. Let me turn to another topic, and that is something that comes up across a lot of FTC cases that I've read, and it's the issue of price transparency. And of course, one of the regulations that the FTC recently finalized deals with fees that are charged, sometimes referred to as junk fees. Can you talk about that, price transparency and the FTC fees rule?
Sure. So the FTC's fees rule went into effect in May. The rule prohibits deceptive and hidden fees for live event ticketing and short-term lodging, including hotel stays. So one thing I like about this rule, and something that, our bureau director, Chris Buffarage, has been emphasizing, is that even though the rule applies in these industries, it's a good way to look at the way the FTC has said to disclose price. So the rule requires disclosure of total price when stating any other amount a consumer might pay. The total price is defined as the maximum of all fees a consumer has to pay for any good or service and any mandatory additional service that is part of the same transaction. The total price can exclude government charges like taxes and shipping charges that reasonably reflect the amount a business incurs to send goods to a consumer. Businesses also have to disclose the nature, purpose, and amount for any fee or charge imposed on the transaction that has been excluded from the total price and the final amount. And also, the total price has to be more prominent than other pricing information except for when the final amount of the payment, like with taxes, is displayed. Now, this provision curbs hidden fees for things like hotel and resort fees, for buying concert tickets online, and where sellers advertise an amount that is not actually the total amount consumers have to pay, but instead they disclose fees only after the consumers are well into completing the transaction. So, for example, when you go book a hotel or book a short-term stay right now and you see that all prices are now being included, that's because of the FTC's rule.
Okay, so one example of a financial services area where the FTC has focused on price transparency is auto finance. Can you tell us about your work in that area?
Sure. So I mentioned earlier that we're focused on protecting consumers from visiting dealerships based on deceptively low pricing in ads. This work also protects law-abiding dealers who are advertising prices honestly. So I'm going to highlight a couple of recent actions here. So in December, we in the state of Maryland announced a joint action against a set of auto dealers and 3 individuals. We said that they were touting low prices in online ads. We said that when consumers call to confirm the prices, the dealer says the prices are available to all, and consumers would take the time to travel from hours away at significant expense to get to these dealerships and then spend a lot of time on the lot. The complaint says that only then did the dealers mention previously undisclosed rebates and incentives that are needed to get the price. The complaint says the dealers also inflated the price by saying consumers have to pay extra for supposedly required add-ons. For example, a consumer was being charged an extra $2,500 for something called the Blazer package. And when the consumer attempted to have the fee removed, a salesperson said, well, the dealership always tacks on this fee. We said the consumer posted an online video, a TikTok, complaining about this. And after the dealer found out the video had 7.4 million views, they decided to rename the Blazer package because it had been tainted in social media. And they started calling it just a protection package and continued the practice according to our lawsuit. The complaint cites a random sample of dealership transactions from a 3-year period, showing that of the vehicles advertised on third-party sites like CarGurus.com and Cars.com, over 88% of consumers paid more than advertised, and those consumers paid thousands more. That matters in litigation. Another recent example comes from an action that we filed in December in Illinois. There we said the dealer advertised low prices, but after the consumers came to the lot, salespeople told them the car had pre-installed add-ons like protective coating and theft protection that cost thousands of dollars. And we said, to add insult to the injury, the defendants actually often didn't apply or install those products at all, after saying consumers had to pay for them because they were already installed. In other cases, we say the dealer said the cars had already been sold. So when consumers arrived at the dealership, they were directed to more expensive cars, often ones with surprise market adjustments added to the price. We settled with most of the defendants for $20 million, and we're in litigation on the remaining individual. So I think the overall lesson of these cases and what you're seeing with a lot of the FTC's work is that price transparency is a focus, and advertised prices have to be the price. There can't be extra fees for add-ons or other items to get what the person was told was the price.
Okay. Now, you recently had an auto case in the Fifth Circuit Court of Appeals. Can you talk about that?
Oh, yes. Okay. So there I'm going to start by describing the underlying case. Then I'll talk about what the order does and what the Fifth Circuit does. So the case is against the Traffic Jam Events Company. It's an ad agency that sent deceptive mailers to induce visits to car dealerships. The mailers were labeled important COVID-19 stimulus documents and directed consumers to relief headquarters to claim stimulus incentives. They also included a likeness of the Great Seal of the United States and a mock check labeled Stimulus Relief Program. But when consumers arrived, they found they were at a used car lot hosting a car sale. We also say that the company sent deceptive mailers saying consumers had won a prize they could claim when they visited certain dealerships. Now, under the order, the individual running the scheme is banned from the entire auto industry. The company and an individual behind it appealed, making a bunch of constitutional and other arguments. The Fifth Circuit recently denied the petition for review. I'll highlight 4 aspects of the ruling. So first, Traffic Jam argued that the removal provisions for both FTC ALJs and commissioners are unconstitutional. The opinion said that Traffic Jam failed to show how this provision caused it harm and rejected the argument. Second, the court rejected the argument that the FTC's dual role as an investigator and adjudicator violates due process. Third, when Traffic Jam argued that the ban was unconstitutional, the court noted that Traffic Jam failed to challenge this issue sufficiently in the underlying case, including when it saw a copy of the proposed order, so it forfeited the claim. Fourth, the individual argued that there is no evidence that he knowingly violated any FTC order or intentionally flouted the FTC Act, and the court noted that such a showing is not required to obtain individual liability. And that is the Traffic Jam case, Alan.
Yeah, okay. So let's get you've only got two more questions that I have for you. So
okay.
First, I want to talk about your work in the debt collection, debt relief, and credit repair area, which is something that seems like it never goes away. There are always issues and problems arising.
That's right, Alan. Debt collection continues to be a top area of complaints for the FTC, and we've been active in the phantom debt collection space recently. So when I say phantom debt collection, I'm talking about situations where a company makes up debts and starts calling and harassing consumers into paying them. Or they harass consumers into paying debts that consumers have already paid or that consumers owe to another entity. We call this debt phantom debt because it's not real debt that's owed to that collector. So the way that companies succeed in this scheme is that they somehow access consumers' personal information, perhaps even bank account numbers, because consumers have applied for something online and that information was shared improperly. And consumers think that because the company has their information, it must be the one they owe the debt to, or they just want the harassment to stop. I mean, some of these threats are pretty egregious. Things like, I'm going to tell your employer you owe debt. I'm watching you. I know where you live. I'm from Jersey. I know where to bury the bodies. In these cases, we allege violations of the FTC Act and FTCPA. And we seek TROs freezing the company's assets and halting deceptive conduct and other law violations while the case is in litigation. And we then seek final orders banning the defendants from the debt collection industry and requiring them to turn over their assets. So an example of a recent action where we did all this is against BlackRock Services. Information about that and many other of our phantom debt cases is available at ftc.gov. All right, now I'll turn to debt relief. Our most recent case here is against a company called Accelerated Debt Services. There, the company deceived thousands of consumers, mostly elderly consumers, into paying thousands of dollars for made-up debt relief services. We said that they first posed as consumers' credit card issuers and then as various federal government agencies or consumer reporting agencies, including Experian. We said that they tell consumers that their credit cards have been compromised and need to be closed. And then they supposedly transfer you to another group, but it's actually just the defendant still, and they market their services saying they can reduce consumers' credit card debts. They charge thousands of dollars in illegal advance fees, and consumers don't get the debt relief that's promised. Instead, they find themselves deeper in debt and with worsened credit scores. We say that defendants have collected over $100 million through this unlawful scheme, and we're in litigation in that matter. By the way, I mentioned an impersonation angle here. The FTC has an impersonation rule that came out last year, and that's an important rule that says you cannot pretend you're affiliated with the government or another business, including by using government seals or business logos or falsely implying an affiliation. All right, on credit repair, the most recent case is one where we won summary judgment earlier this year. There, the defendants were advertising that they could improve consumers' credit by deleting negative credit history and selling credit building products, and they charged an illegal upfront fee. We filed the action in the Southern District of Texas, and the court found the defendants were liable on all counts and entered a permanent ban on operating the credit repair industry and a $10 million penalty and $9.4 million in consumer redress. And that's a quick overview of our work in those areas, Alan.
Okay. So we talked about companies that offer, particularly fintech companies that offer new types of products as alternatives to bank loans or new types of payment platforms. So let's talk about a related topic, and that's crypto platforms. Many crypto platforms have promised banking type services, Malini, can you talk about what the FTC is doing in that area?
Sure. So we have seen crypto platforms say that they're as safe as banks and they're a good place to store and access funds, but then failing to live up to their promises. So a good example is a case that we settled earlier this year against Voyager. Now, by way of very brief background, Voyager, we say, deceived consumers into transferring their crypto assets to the Voyager platform. They portrayed Voyager as a safe alternative to traditional banks and assured consumers that their funds were insured by the FDIC, according to our complaint. In reality, we said Voyager was not an FDIC-insured institution, and the FDIC does not insure crypto assets. So when Voyager declared bankruptcy, consumers were without FDIC insurance, and they had no recourse to recoup their frozen assets. Our recent settlement with the individual defendant requires him to pay $2.8 million to settle the charges. So a quick takeaway here, and from a lot of the cases I've been talking about, today, is whether you're looking at crypto or fintech work or other cases, if companies want to distinguish themselves from the competition, they have to do it on things that actually make their products better. Companies can't pretend to be safer than the alternatives. You can't pretend to be safer than a bank if there's no safety net for consumers when things go wrong. And that is our crypto work.
Yeah, okay. All right, well, we've come to the end of your segment of the program, Malini, and really want to thank you again for taking the time today to share with all of our listeners what the FTC is up to. And it surprised me, to be honest with you, because unlike, I guess I could refer to it as your sister agency, which has not been doing very much since under the new administration, my view is it looks to me like the FTC hasn't missed a beat. It's still the same FTC. And, one of the things I will be telling all of my clients after listening to you today is, they always talk about, or we previously talked about how the states are going to fill the void left by the CFPB, but you don't forget about the FTC. And I think a testament to that is just what you've described today and how active you are. So once again, my thanks to you. And I know you have to log off.
Okay, thank you so much, Alan. I appreciate it. Bye-bye.
Okay, bye-bye. Okay, so in the remaining time that we have left, I'm going to turn to my colleague now, John Culhane. And I'm not going to ask you any questions, John, but you do have a number of topics I know that you want to share with our audience.
Thanks, Alan. Yes, I'm going to talk a little bit about the current leadership at the FTC. Then I'm going to talk a little bit about staffing and budget changes. Certainly, as you noted, a very different story at the FTC compared to the CFPB. Then I'm going to talk about regulatory developments and the FTC's spring 2025 regulatory agenda. And then I'm going to close with a few observations about priorities for the FTC going forward. Although I think it's fair to say that just about everything Malini mentioned is an example of the priorities for the FTC going forward. So let me say just a few words about the current leadership at the FTC. The current chair is Andrew Ferguson. He actually was a Biden appointee. He was appointed in 2024 to be a minority Republican member of the FTC. And then Trump elevated him to chairman on January 20. He succeeded Lina Khan. Senate confirmation was not required because he was already an FTC commissioner. The current FTC commission is basically three Republicans, Chair Andrew Ferguson, and then Commissioners Melissa Holyoke and Mark Meader. Melissa Holyoke was appointed. She's also a Biden appointee, and she was filling part of an unexpired term. So one thing to watch for in terms of FTC leadership is that her term will expire on September 26th. Mark Meter is a recent Trump appointee, so he has a 7-year term ahead of him. There were 2 Democratic members of the commission, but I think probably all of our listeners know that Trump fired them on March 18th. The most recent developments in the litigation involving Rebecca Slaughter, just yesterday, Chief Justice Roberts issued an administrative stay on her reinstatement, which had originally been ordered by District Court Judge Ali Khan back in July, and then essentially confirmed by a 3-judge panel of the D.C. Circuit by a 2-to-1 vote on September 2nd. So that stay is in place. She is not on the commission, and there's a request for the Supreme Court to hear the merits of the case against her, which is really a request to overturn Humphrey's executor. Alan, you want to add anything there before I
guess just an observation, John. And while my view is that my own is just a personal view, is that in light of Humphrey's executor, that 1935 chestnut, and the language in the Federal Trade Commission Act saying a commissioner can only be terminated by the president for reasons that constitute cause, I think that should be the law. But I think that the Supreme Court has previously given a signal in connection with firings related to the NLRB and one other agency that they are poised to overrule Humphrey's executor, with the only exception that I think they're going to make is for the Federal Reserve Board. I think there they will think of some justification, some way of distinguishing the Fed from all the other so-called independent agencies. But here's the observation. The observation after listening to Malini talk about what's still going on at the FTC, whether there would be 1 or 2 other minority members of the commission, I don't think it would matter very much. The Republicans would still outvote the 2 Democrats, and it's hard to see how things would be much different. They're already very active at the FTC. I suppose the only thing a minority member can do, really as a practical matter, is dissent from an FTC action. And maybe there's some value in saying, if you're a minority member, well, if you do this, I won't write a stinging dissent. Maybe. Is that going to mean a lot? I don't know. What do you think, John?
Well, I think those are valid points, and interesting. That's part of Rebecca Slaughter's argument for reinstatement is that what difference does it make if she's on the commission? She's not going to derail the agenda of the Trump administration. Although I'll mention towards the end of my presentation that she did write kind of an interesting dissent in one particular case on an issue that I think will be, or in an area that I think will continue to be an area of concern for the FTC. The current director of the Bureau of Consumer Protection is Chris Mufarage, as Malini mentioned. He's a former chief of staff and attorney advisor to Commissioner Holyoke. He previously worked at the CFPB, and he's also got experience working in the consumer financial services industry. At one time, he reportedly owned and operated a buy here, pay here auto dealer. So he's an interesting person to have as director of the Bureau of Consumer Protection. Let me talk about staffing and budget changes. The FTC is obviously not the CFPB. It hasn't been whittled down to a shell of its former self, but there have been some changes. The staffing at the end of 2024 was approximately 1,300 people. And then in early January, at the start of the Trump administration, it was down to about 1,220. So there were some 94, 95 departures. And there was, in February, there were some probationary employees and maybe a few other employees who were dismissed. Media reports about that say that only around a dozen or so employees were terminated. So this is by no means the kind of gutting of staff that occurred at the CFPB. What is interesting, though, in terms of staffing going forward, is the 2026 Congressional Budget Justification Report that the FTC released on May 30, and then the testimony about the budget going forward of Chairman Ferguson in Congress. The FTC's request for budgets suggests that it's seeking to have staff of full-time employees of around 1,100. So that's approximately a 15% reduction, but that's not the gigantic reduction that occurred at the CFPB, obviously. And according to Chairman Ferguson, that reduction is going to be accomplished not by a reduction in force, but by voluntary departures. So the FTC is expected to offer early retirement incentives and separation incentives to staff to reduce the number of full-time employees. It's not entirely clear how this will affect the Bureau of Consumer Protection, because the FTC's budget, when it's reporting on staffing and dollar amounts for staff, doesn't specific reports by activity. So we do know the budget, which would mean a loss of 30 in the Bureau of Consumer Protection. But that's about it in terms of staff reductions. I'll just repeat that that's all going to be accomplished by voluntary departures to incentives for retirement and early departure. Let me talk a little bit in the few minutes we have left about regulatory developments and the spring 2025 regulatory agenda for the FTC. The main thing about the regulatory developments is that virtually all of the controversial Biden-era regulations have been struck down in the courts. So that includes the CARS rule, the non-compete rule, and the FTC just recently said it wasn't going to pursue its appeals of the adverse decisions over that rule, and the click-to-cancel rule. The junk fee rule, Malini commented about that applies to live event ticketing and short-term housing is still in effect. There are no challenges to it to date. In terms of a regulatory agenda, I think that the key things that showed up on the regulatory agenda, one is a bit of a relic. The FTC is reviewing, as part of its routine review of existing regulations related to identity theft. So that includes the red flags rule and the card issuer rule. And there have been a number of comments to the FTC about providing clarification and maybe some room for industry members to argue that things are not identity theft, they're simply disputes. The more important one, and we did get a question about this, is that the FTC has noted that it has a proposal to extend its impersonation rule to individuals to cover deep fakes. And that would be pretty significant. That would be a prohibition against impersonating individuals. That would include voice cloning. It would also include images through AI generation. And that proposal also includes a prohibition on companies that further any impersonation. So that's pretty broad. Anybody selling goods or services that they know or have reason to know could be used to further impersonation scams would be on the hook. So that could include providers of AI software. Where that rule stands right now is that the administration, the FTC staff is reviewing the comments that were received on it. But I think there's a fairly strong signal that may go forward. Let me just say, we're getting to the end of our time, so let me just say a few things about priorities. The comments that the commissioners and that Director Mufaraj have made have indicated that in terms of subject areas and legal issues, there'll be a big focus on fraud, meaning real fraud with concrete harm to consumers or small businesses. There'll be a focus on protecting elders, including protecting service members and veterans. Privacy is likely to be a big focus of the FTC going forward. Commissioner Holyoke is very committed to focusing on privacy protection, and that includes enforcement of the Children's Online Privacy Protection Act, as well as the Fair Credit Reporting Act and the Gramm-Leach-Bliley Act. And then, as I mentioned, there'll be a focus on, in terms of unfair, deceptive, and abusive acts and practices that cause actual harm to consumers. Malini, I think the examples that Malini commented about almost all fall into one or more of those categories. Evidence of real fraud, evidence of concrete harm to consumers. There were instances of protecting elders. So I think those consent orders are all things that we should focus on going forward. The one thing that I would add with regard to the rules that were overturned is that it looks like we may very well have, in lieu of trade regulation rules, we may have regulation by enforcement. In that regard, the FTC recently brought an action against Gateway Services, Inc., a pet cremation company, over its non-compete practices. The company has had universal non-competes in its employment agreements since 2019, applying to all employees. So that includes both highly compensated executives down to hourly workers cleaning the facilities. The FTC is seeking three forms of remedies in its proposed consent order. It's looking to have Gateway stop enforcing all non-competes. It's looking to have them notify all employees that they're no longer subject to non-competes. And then it's looking to impose a prohibition that would operate to restrict Gateway from prohibiting former employees from contacting prospective current or former customers, at least as long as they hadn't worked with those customers or contacted them within the last 12 months of their employment. Malini talked about subscription issues and click to cancel or cancellation difficulties. I think that's going to be the substitute for the end of the click to cancel rule. And I think the LA Fitness case that she talked about at length is indicative of where the FTC is going to go. I think we'll probably also see a broader focus on fee issues. Malini mentioned a lot of pricing cases and hidden fee cases. And we may very well see auto dealer deception cases as well. And I think I've run us about a little bit over our time. We had two questions that I just wanted to respond to that came in. Whether there'll be any anticipated changes in FTC participation with state attorneys general. I think the only change that we're going to see there, I think the FTC will continue to be very active with state attorneys general, but the cases are going to involve real fraud. They're not going to involve sort of phantom harms or ephemeral harms to consumers. And yes, the FTC is going to be very active. It can't be the CFPB. It doesn't have jurisdiction over financial institutions, but it clearly has an active agenda, a very aggressive agenda. And if it's down to 1,100 employees, it's going to keep them all hopping. Let me close there.
John, the one thing that didn't get mentioned by Malini, and you haven't mentioned it yet, and I'm wondering if you have a thought on it, is the concept of dark patterns. That used to be a mantra of the Federal Trade Commission. That is, setting up your website so that it deceives people. It makes it more difficult for them to figure out how to cancel. She did refer to right to cancel, but at that term, do you think it's just that they're not using that term anymore?
I think it's partly that they're not using that term. It hasn't been mentioned by any of the commissioners or by Ms. Farage. And I think in part because when they used that term before, they used it to attack designs that they disliked, even if those designs didn't necessarily result in significant material harm to consumers. And now the standard is actual harm. So I think the concept may be lurking behind the curtain, but we're really only going to see claims of harm and the assessment of fees and the difficulty in canceling to avoid the continued assessment of fees as the way that plays out for the FTC.
Yeah, okay. Well, thank you, John, very much. Although Malini is logged off long ago, again, I want to thank her publicly for joining us today. And I, in particular, want to thank all of our listeners, and we had a huge turnout today. But with that, I hope everybody enjoys the rest of their day. To make sure you don't miss any of our future episodes, please subscribe to our show on your favorite podcast platform, Apple Podcasts, YouTube, Spotify, or wherever you listen. And don't forget to check out our blog, consumerfinancemonitor.com, for daily insights about the consumer finance industry. And if you have any questions or suggestions for the show, please email us at podcast, that's singular, at ballardspire.com. Stay tuned each Thursday for a new episode of our show. Thank you for listening and have a good day.